Hi everyone and welcome back to the Commerce Moves Slow YouTube channel. In today's video, we're going to be discussing the proposed takeover of Japan's most beloved convenience store, 7-Eleven, and possibly a store that you've seen all over TikTok and a lot of other social media platforms whenever people travel to the region, and what it means for the future of M&A in Japan. 7-Eleven is practically a fixture on every street in Japan. And so when the idea or the takeover was proposed, it sent shockwaves through corporate Japan. So who is behind this? Who is potentially going to be buying 7-Eleven? So it's the Canadian chain Alimentation Couche-Tard, which we're going to be calling as ACT from this point forwards, is proposing to buy the chain's parent company, 7&I Holdings. And this could cost as much as $86 billion, according to Bloomberg Intelligence, which for something which has become a national institution in Japan. Now, the list of iconic brands as you walk through a 7-Eleven is very, very lengthy. So to give you a couple of examples, if you haven't seen one yourself, there are beverage makers like Asahi, Kirin, and Suntory, which are all drinks. Asahi beer, you've probably heard of that before. And that fills up a lot of the country's abundant vending machines. Then we have prepaid cards from Nintendo games. We have Mitsubishi ballpoint pens. We have Meiji chocolates, the skincare brand Shiseido, and that is just to name a few. So as you're walking through a 7-Eleven store, you see all of these iconic brands within these stores. Now, where this shift is coming and where sort of the story has taken off is because of ACT's unsolicited interest in 7&I Holdings, which, as we said, is the parent company of 7-Eleven, and it is listed on the Tokyo Stock Exchange. So it currently has a market valuation of $36 billion US dollars. Now, if this actually comes on and actually, this takeover does happen, it will be Japan's biggest foreign-led takeover, and even if it does not, there's potentially a prospect that Japan's M&A scene will never be the same again. Before we look at the reasons why this has happened and also what might be happening next, let's take a couple of steps back and look at the history of 7-Eleven, because you might be surprised to hear about where it all started. When we think of 7-Eleven, we so easily think of Japan and sort of Asian delicacies in general that you'll actually be surprised to know that 7-Eleven did not begin in Japan, but it actually began in Dallas, Texas in 1927. That's when the first convenience store was opened. Now, the first in Japan, so the first 7-Eleven, opened 50 years ago in Tokyo's Toyosu area, and the first item sold, interestingly, was actually a pair of sunglasses. So at the time, it was the inaugural franchise store under a model imported from the US, and a few decades later, the Japan Konbini experience, so Konbini is a term used in Japan for convenience stores, experience has become so successful that then the Japanese offshoot 7&I Holdings wholly bought out 7-Eleven from its US parent company in 2005. So since then, it's been wholly opened by 7&I Holdings, which is based in Tokyo, but it actually originated in North America. So 7-Eleven pioneered the sale of the onigiri rice balls in the 1970s, and since then built out a vast range of cheap, fresh, and surprisingly nourishing food with very interesting techniques. So it had the just-in-time inventory management, and enabled customers to pay bills or withdraw cash at any point, breaking the monopoly of a lot of banks that closed at 3 p.m. and on weekends. So especially during that time, you didn't have the possibility of withdrawing cash at times when banks were closed. When 7-Eleven came in, it disrupted this model, and it meant that you kind of had a 24-hour ATM, and that was a huge sort of pioneering moment in the convenience store movement. 7-Eleven is the world's biggest convenience store chain. It has 85,000 outlets across 20 countries and territories, and around a quarter of those 85,000 shops are actually in Japan. And of course, there's still 10,000 in the US. There are more than 1,100 stores in Hong Kong and Macau. And the reason I mention this is because that's actually where I first came across 7-Eleven myself, and partly why this story really caught my attention. As someone who spent 5 years in Hong Kong, 7-Eleven was one of those places where you went with your friends, you went when you needed a quick snack, you went when, with your parents to go to the ATM. And so it was one of those kind of, quintessential parts of everyday life. And so this story had a bit of a personal connection because it was a place that I really associated with whilst I lived in Hong Kong, and still I think something that is a real memory for me. So I never actually got to visit Japan, and it's definitely on my bucket list to go see it. But when I saw a lot of the TikToks that kept talking about the 7-Eleven, I could relate to a lot of it because there was one about 5 minutes away from me when I used to live in Hong Kong. Now, enough personal stories. Let's talk a little bit about why this takeover and takeover of a lot of Japanese companies hasn't happened before, and what are the real factors that are enabling a company like ACT to come in and even propose this takeover. So there are three key factors to bear in mind, and this is actually really important because a lot of times when we talk about M&A activity and we talk about the reasons why certain takeovers do happen, there are normally a couple of factors which keep coming in. So in Japan, the first and I think the biggest factor is corporate governance reform. Now, what do I mean by that? So for decades, foreign buyers would have gotten nowhere in Japan, and that's partly because the kind of C-suite executives. So that's our kind of that's the organized kind of term for senior executives in a company, were never really asked or never really kind of forced to prioritize shareholder interests. So the Tokyo Stock Exchange, exactly for that matter, is actually filled with companies who have global name recognition. So just to name a few are Nissan Motor and also the chemicals firm KOSE or KOSE that are seriously undervalued. And this has actually meant that a lot of times unsolicited offers has never been taken seriously by C-suite executives. But there was a big change last year in Japan, which has meant that these have slightly changed. So last year, the Ministry of Economy, Trade and Industry, shortly known as METI, actually changed takeover guidelines to prod CEOs to take these offers seriously and to actually consider them. So the hope was to stimulate domestic consolidation, aka, bring a lot of these companies together and ensure that those companies are not undervalued. But it might have had the unintended effect of Japan's most famed companies to be exposed to a lot of foreign buyers and therefore foreign takeovers. So ACT, for example, which is the company that is supposedly wanting to take over 7&i Holdings and 7-Eleven, has a market capitalization which is 1.5 times larger than 7&i, even though it only has a fifth of the number of stores, and they are the Canadian owner of Circle K. So that they only have 1/5 of the number of stores, but their capitalization is a lot higher. They are valued a lot more than 7&i Holdings. Now, Japanese companies are not rated as if they are profit hungry. And because of the other key effect being the country's ultra low interest rates for such a long time, means that a lot of these companies were seriously undervalued. So therefore, 7&i, if it chooses to reject ACT's bid and ACT's approach, it may be forced to defend itself with a raised valuation and a promise that it's prepared to exist primarily in the service of shareholder interests. Now, I think for those of us who are listening from Western countries, particularly if you are used to listening to, what's happening in the American economy or the UK or other countries for that matter, this seems like it is quite the norm that shareholder interests are always, looked after first. But that has not been the case in Japan. And so this is a huge change for a lot of the corporates and a lot of the C-suite executives that do work at the top of a lot of these Japanese companies. Another reason is a cheaper yen and also the increase in activist investors. So the cheaper yen, there's a prediction that the yen has probably bottomed out. So it's kind of reached its lowest point because there has been a 10% increase since the 38-year low in July, which is, which has meant that we can probably see or predict that the yen will rise. However, for now, it is still cheaper for companies to sort of come in. And the cheaper yen means that more American or Western markets can come in and try and buy over companies for a cheaper price because their currency is sort of valued at a higher price. And the other big reason is also activist investors. So there is an activist investor within 7 and 9 Holdings, Dan Loeb, the founder of Third Point, and he took a stake in 2015. So since then, in order to please shareholders and in order to kind of increase the value of the company has made a raft of changes. So they have sort of, kind of scaled back their supermarket presence. They have also done things like sold the Sogo Suebu department store chain, and they've launched share buybacks. However, we can see that, because the yen is still at that lower price and activist investors are more accepted, that these things are meaning that someone like Loeb, for example, will want to know, all the reasons as to why the takeover is rejected, if indeed it is rejected. And the final reason, you can probably guess, is geopolitics, as always. So a shift in global investments and also US-Sino tensions has also contributed to the deal momentum in Japan. So this is actually an interesting concept. So Japan is the largest economy in the region outside China. And friendshoring is something that they have really used. And this idea of friendshoring is that rather than kind of, looking at or working with companies which to manage their production and supply chain activities who are at the lowest cost, they are actually selecting partners in a group of countries that are geographically closer and also aligned politically, economically, and socially. So it's this idea, you can sort of see from that term, friendshoring, that you're not just looking at cost, but you're actually looking at more than that. You're looking at social interests, looking at political interests, and you're also looking at the end of the day at how close they are to us in the region, in order to think about, what happens in the future in terms of if right now we can see with the Russia-Ukraine war that there are sanctions on different countries, and again, geography is playing a big role in terms of how the economies are doing and how they're still getting goods in and out of the country. So this friendshoring aspect, you can sort of see why that plays a role, because Japan wants to ensure that it is allied with those around it in terms of geography, not just looking at costs. So I think that again is an interesting sort of development, and is probably also why a lot of there is interest and deal momentum in Japan, but Japan wants to still ensure that it is aligned with those around it and has good relations with all of them. One proposal is that antitrust concerns, so the concern that foreign buyer taking over might be leading to lower competition and more of a monopoly, could impede the deal. But if it is successful, it would be the largest corporate foreign buyout of a Japanese company ever, which is even surpassing the $18 billion acquisition of Toshiba's memory chip business in 2017 by a consortium led by Bain Capital. Now, the kind of this prospective acquisition of 7-9 Holdings signals, I think, that there is definitely a transformative movement for Japan's M&A market. As we have explored, there have been favorable economic conditions, there's been recent corporate governance reforms, as we discussed, and also evolving global investment trends. And so Japan is definitely emerging as a popular destination for foreign acquisitions. As the deal progresses, it's definitely going to set benchmarks for future transactions, and also it's going to increase Japan's standing in the global M&A arena. And I also think that it's going to give confidence to other companies to actually come in and want to potentially apply for a bid to take over one of the Japanese companies. And as we know, a lot of them are not just listed highly in the Tokyo Stock Exchange, but definitely have a lot of global power. And so until now, the companies that maybe other Western markets have not looked at as potentially an acquisition, this might set the standard in order for that to happen. So I think it'll be interesting to see what happens in this deal next, and also what it means for the future of Japan's economy. And with that, thank you so much for watching today's video. I hope that you enjoyed it and I hope that you learned something from it. Definitely let me know your thoughts down below of 7-Eleven, your experience if you've ever been to one, what you think about the story, what you think about the M&A activity in Japan in general, and also any other questions that you have. I'm also learning about the story as I'm reading it. So if you have any questions, do let me know and I'll definitely try and find the answers for it. But for now, take care, goodbye, and I'll see you very soon in the next video.